requests were really, what's going on? Am I well positioned? Is there something I should change? And in general, a lot of the advice I've given is not to make major changes. Again, if a client is well diversified, that is the best protection you have. The best protection is not timing the markets. It's not trying to find short-term asset classes to park money. The best defense is to be well diversified. So if you're well diversified, and if you've managed things in such a way that you're not under pressure, meaning you're not leveraged to the point where you have to sell assets, then your best bet is to wait. Markets will come back if you can wait. Some people can't. Yeah, but so those have been more, I would say, the requests that I've gotten, and I've had some people get in touch with me about margin situations because those, as I mentioned, can be not so nice. But it's also a time, and it's not my expertise, but I work with partners that are in law and other areas to look at things like, obviously, wills, wealth planning structures, trusts, medical proxies, succession planning. These are all the things that we always need to think about, but in today's terms, we certainly need to think about. So again, it's on the list. It's not what I do myself, but I think as advisors to clients, we need to be aware of the needs and who can help our clients with their needs. If I knew the answer precisely to that, I'd probably not be on the podcast. I'd probably be trading right now. But my general feeling is that I don't think we've reached the bottom. I think we could drop lower depending on the news. Going back to what I said, if that denominator starts to widen, people's confidence will get lower and people will sell. I think you have to look at it in a few different ways. You know, the other day I read an op-ed piece by Robert Shiller in the New York Times. Robert Shiller has a Nobel Prize in economics and is very schooled in markets. And his basic read on the market was, you know, it looks like a lot of emotion is driving it. I wouldn't get too worked up over it. Stocks are cheaper now than they were a few months ago, and long-term investing is probably a good thing. And you know what? I think, you know, that's pretty reasonably good advice. So if you look at, you know, what's happened over the last months, obviously when the pandemic started, there were massive sell-offs, and there were different reasons for that. Part of it was this denominator spreading out and people feeling like they just don't know what's going on and scared. Two, as you rightly say, there were a lot of margin calls because money has been pretty cheap the last few years. Clients are in a lot of cases extended, and all of a sudden, all of this came to a head. And so margin calls were made, positions were covered, and that obviously contributed to some of the down selling, and that brought the markets down. So there were some technical corrections in there, as it were. Going to the present, I think that the markets have already, to go to the comment that you introduced the question with, look, earnings will be down by design. There's no surprise in that. So it's not a projection that earnings will be down. We know that. And that information is obviously filtered somehow into the projections. I think the projections for the markets are based on the idea that, to go back to what I said earlier, we can move from phase one to phase two. I think if we can successfully transition to phase two by the summer for most countries, then the markets will have a sense that things are getting back to normal, okay? Some business will clearly be lost, but we will move forward. I think an important concept here that people need to understand is when you have this so-called induced coma with the economy, right? You basically have to keep it going, right? And as I mentioned, the central bank provides liquidity, the government provides funds to individuals and to companies, and so on. So what we have to remember is that during the period of this shutdown and lockdown, revenue will be lost by design. Now, some of it will come back. And a very interesting analysis, a former colleague of mine at UBS, Paul Donovan, who's the chief economist for the wealth management, very, very bright guy, did a really useful analysis looking at consumption. And so if you look at consumption in this process, some percentage of consumption, he estimated about 60%, carries on. So rents, food, basic necessities,
Okay.
and so on. That's not lost. That goes on. Then there's about uh, 15% or so that is deferred. So if you wanted to buy a television today and you can't because everything's closed and you don't want to buy it online, you wait and you'll buy it. You'll buy
Hmm.
it maybe in the summer. So some consumption is postponed, not lost. Uh, but some consumption is absolutely lost, right? And he estimated that about 25% of
Hmm.
the economy. So there you have restaurants, you have travel. If you didn't eat in a restaurant yesterday, you can't make it up by eating there next week. So all of that is lost. So I think that's one important thing to keep in mind is that we understand that some of that will be lost. The real question is how quickly will it come back? How quickly will people buy those televisions they didn't buy before? How quickly will people return to restaurants and so on? So that's one really important part of the story. The second part of the story is employment and incomes, because different countries have taken different approaches to the massive job losses that are happening. In the US, they're treated as unemployment and they're treated as lost jobs. In Europe, they're not because it's a different approach. And so they're treated as furloughs. The work remains. The government essentially gives companies money to pay people. Which approach is better is a matter of opinion. I personally think the European approach is better because it will be harder for people to re enter the workforce when the economy begins to start up. We shall see. I hope I'm wrong, at least on that point. But that will be the second big question: is how quickly employment can be reset up and people can get back to work, and the many, many millions who have sadly lost their jobs, how quickly they can come back in. Because if they can't reintegrate, then consumption cannot go back up and the economy cannot get going. My gut feeling on this is a simple one, which is that things will take longer than we think initially and then happen quicker than we think. So I think that, as a lot of things, if you study corporate bankruptcies, they go on for a long time, much longer, and then they happen, and it
Mm.
happens suddenly. So I think this is it's going to happen also in the economy. I think that people, at least anecdotally, when I talk to friends and people, I don't get a feeling that if the economy is open tomorrow, everybody will rush into restaurants and rush into shopping malls and rush into events. I think it will be a gradual process, and that includes travel. So I think it will take time. Um, this is a big question. How quickly will people readapt? Will they be cautious? And then I think at a certain moment, it will click. It will click sometime in the second phase and start to pick up again. Um, people in some ways have short memories. After 9/11, for those of us that remember 9/11, it seemed like the world would never come back to normal, and it did. And in many ways. And so I think the same thing will apply here, although I do think we're being overly optimistic by thinking that these economies can click into gear overnight. Uh, there are so many businesses that have been closed, restaurants closed, other businesses closed. You don't flip a switch and open them back up. So either from the supply side, from opening and the establishment and actually running the business, or the demand side of getting customers back in the doors. So I think that is in. But to go back to the point, I think markets have discounted this in. I think this is understood. I think the thing that will disrupt markets the most is if the phases are pushed out for health reasons. I go back to this over and over. I think some of the things we have some control over, we have no control or little control over how this virus will spread and how quickly we can come up with vaccines. We have a lot less control. So I think, and that's why my matrix has that in bold at the top, and then everything flows from that. So that's a little bit of an explanation. I think for the purpose of investors and for the purpose of our business, the wealth management business, look, I think we have an obligation to try to make sure clients are diversified, that they have allocations according to their needs, that they have liquidity to live their lives, and it's all in this checklist that I put together. But I think that there are a number of factors. And that are not focused around whether the market went up or down today, but focused on the bigger picture and the longer term needs of clients. So I think the stock market is one piece of it. There's a whole debt market out there that offers different opportunities. Corporate debt, which yields had come massively down over the years, are now spiking again. So for those that want to get into debt investments, there are opportunities. I mean, UBS, for example, is recommending that there are good opportunities in corporate debt at the moment because it's undervalued compared to where it can get to. Just as an example, that was not a promotion for UBS or for what they're recommending, but yeah.
Yep. No, just wanted to point out none of everything we discussed in this podcast is financial advice. It will be in the disclaimer of the podcast in the beginning as well. Also, make sure if you work with private clients, make sure you check out the checklist that Greg put together. It's really simple to follow, and it's just very thorough. You covered a lot of the important things there. And speaking of.
Thank you, Vadim. Let me just say, sorry. It's really meant to be simple. So it's one page, and I think that people who work in some capacity with clients, and some of them I know are listening to this. I hope are listening to this. I think we have an obligation to protect them in terms of markets, but also in terms of other things. So you mentioned margin calls. So there was a very bad period in March where margin calls were all over the place. And I saw situations that were not handled all that well for clients, okay? So normally, in normal times, margin calls occur. Normally, they're dealt with in a simple way between the banker or the advisor or whoever it is and the bank and the credit department. And they're normally negotiated. It's normally, not always, but often amicable. What's happened in this pandemic is it has often gone badly, and communication has gone badly for two reasons. One, the banks have felt under tremendous risk, broad risk, because portfolios across the board are under pressure. And two, because there's a limited amount of time to deal with individual cases. Yeah, so they're not getting addressed well. So I really urge everybody, if and that period has passed a bit. The markets have come back, and a lot of the margin. So it's a bit beyond that. But it is a really important responsibility we have to make sure that clients are protected. So I just wanted to say that, and that's again in this list along with other points.
On 30th of March, JP Morgan in Alternative Investment Division announced that they're seeking to raise as much as 10 billion in an effort to bolster the spending power as the COVID pandemic roils the global markets. So in this period of uncertainty, where are there any assets that outperform traditional assets? Maybe any alternative assets that prove themselves as pandemic proof?
Pandemic proof, I don't know if you want to call it pandemic proof, but look, a couple of things. The first one, which always is the first one everybody talks about, is cash, right? So people say, oh, just sell out everything and go into cash. That is not ideal. Over time, cash is the worst investment because it's basically earns nothing and you're taxed on it every year through inflation. Ray Dalio can explain that much more eloquently than I can, but that's essentially cash. The second is, the hedge fund space. Of course, hedge funds were by design meant to generate absolute returns and be, to not follow the markets. And in that space, there are some examples of people that have been, we could say, clever, or so Bill Ackman is one at Pershing, which got a lot of attention. He bought credit default swaps to hedge the portfolio. In the end, it was successful. He generated about $2.5 billion from those, which he plowed back in, which is important, back into his core holdings. So he's now long again in the market. And again, that's one example. That could have gone very wrong. In the end, it cost him $27 million for the hedging. But on bad days, it went up as high as $800 million. So he could have lost a lot. In the end, it turned out well. Paul Singer at Elliott, similar thing, did some hedging and protected. So yes, there are examples of some hedge funds that have done well. Ray Dalio, by the way, as the biggest hedge fund in the world, did not call it right, and he'll be the first to say. And he lost 20% in March. He was down 20%. So hard to say in general terms. There are specific managers that have done okay. But again, I go back to what I said earlier. It's about diversification. It's very hard to pick which asset class or which specific investment and for what period of time in the midst of a pandemic. So diversify, and that's your best weatherproof strategy, I would say.
With more than half of the staff of real estate businesses being sent to furlough, at least in the United Kingdom, yeah, sales are going down, viewings are seized altogether. So you can't rent a property right now. You can't really buy. You can, but it's really hard, and nobody is doing that. So how do you see coronavirus affecting the property market, and what are the potential implications for the real estate in short and long term if restrictions will not be lifted until June 2020?
Okay, well, it's a good question. Again, I think it will vary somewhat country to country, but in general, the biggest risk for the property market is default, right? So default in retail and or commercial, and that is not clear what the level of defaults will be. So in certain countries, the governments have put moratoriums on rental payments. It is not clear when those will be lifted, what funds will have to be returned, whether the governments will help in any cases. But it's important to understand there are knock-on effects. In many cases, landlords have mortgages to pay. If they don't get rental income, there's a cycle that is created that is unhealthy. So I think fundamentally, the defaults depend on two things. They depend on the length of time that this takes. So back to the phases, if we can successfully get to a place where people are back to work, people, to go to your point, can go look at properties and rent properties, because if everybody is isolating at home, they can't do anything. So how quickly we can move into that next phase, and what the government approach will be to rental payments, moratoriums, and so on. The commercial space, so far, office space seems to be okay. But that again will depend on the timing. But retail will be hit very, very hard, very, very hard, for a couple of reasons. One, because businesses will not be able to get back up and running, as I mentioned, and so that will free up a lot of space. And secondly, because of what we both talked about, this secular trend to online business over time, which was already happening, by the way. So it's not a new trend. Okay, so I think we have to just watch the space. We have to hope that the next phases can kick in and we can get back to some sort of a more normal place. What I will say as an aside, for those listening that have real estate investments or work with advisors that are invested in real estate, it's an important time to review and to try to understand where you are. Again, you mentioned earlier, I work closely with a firm here called Global Gate Capital. I think they do a great job. And they have a large real estate portfolio, and the approach has been to do a bottoms-up review, tenant by tenant, to basically figure out what the risks are. And there's no other way around it, because at the top down, there's what the governments do and so on, and what the macroeconomic situation does. But then there's the bottoms up, and you can't avoid that. So anybody out there that is invested in real estate needs to make that analysis and look at, what properties do you have? If they're commercial properties, who's staying in them, and what are the risks there? And just to say, the analysis today of the corporate market is very complicated. It harkens back a little bit to 2008, because there's so much interconnectedness between companies. So you may look at one company that's either a tenant or a company you invest in and decide that that company is solid and that company is sound, but it may be that they have suppliers or they have clients that are not. And so even if they are sound and their balance sheet is in good shape and their business proposition works, they may get hit with external forces that disrupt their business and go against their viability. Yeah. So I think that's why, and again, if this is clients that have businesses, I mentioned this in the checklist, it's important to do a review of suppliers and supply chains, because in very strange ways, supply chains that these days tend to be more international, if not global, can be easily disrupted. If there's claims on assets, you can have patents that wind up in bankruptcy courts and frozen, and then suddenly products cannot be produced. So I think it's very important, and a very sad example of that is the production of ventilators globally, where we've learned how complicated it is to get parts in the midst of a pandemic from different locations based on different scenarios. So I think we need to really be cognizant of those things and do a proper analysis.